The big jobs report for December was just released, and it was stronger than expectations, yet the markets had a rally. Why? Because it's exactly what the Fed was looking for with wage growth. Let's jump into some of the data. So we just got the December jobs report, and it showed on the headline that there was 223,000 jobs created during that month. Now, this was stronger than estimates that was looking for 200,000. Now, you have to remember, this is a little bit of a backwards world that we're in. In a typical market, if you see strong jobs numbers, it shows the economy is doing well. You would see risk on assets like the stock market perform well. But right now, things are backwards. Why? Because the markets are trying to handicap how long the Fed is going to keep their Fed funds rate elevated, and are they going to keep hiking? How far are they going to go? How long is it going to be elevated before they begin cutting the Fed funds rate? And right now, when we're seeing good news on jobs, when we're seeing inflation high, those are all bad signs for the market. It typically would be good signs because it means the Fed is not going to be satisfied with where the Fed funds rate is, and they might think they need to be more restrictive. But even though we saw a stronger job creation number, there were some things to temper this report. There was negative revisions to the previous two reports of October and November of about 28,000. When you factor that in, this jobs number was pretty much in line with what the estimations are or where that bar was set. But you have to also remember, there's two surveys within this report. There's the business survey and the household survey. The business survey is where you get the headline number. The household survey is where you get the unemployment rate from. Now, within there, they have their own job creation component. It showed not 223,000 job creations. It actually showed 717,000 job creations. And when you take a look a little further, the labor force increased by 439,000. So while that looks really strong on the surface, and it caused the unemployment rate to decrease from 3.6 to 3.5%, you have to go deeper than the headline. Of the 717,000 jobs created, almost 680,000 were from part-time workers. Only 38,000 job creations were full-time. Could be a lot of people getting hired ahead of the holiday season. Also, 380,000 of the total were multiple job holders, meaning people probably having to find part-time work and things to make ends meet because they're feeling the squeeze of the economy right now and things slowing down and the Fed hiking and making things more expensive. But here's the big part. Average hourly earnings, or how much people are making per hour, went only up 0.3% in December, and the year-over-year numbers declined. If you look at the previous report for November, originally it showed that average hourly earnings were up 5.1% year over year. They revised that lower to 4.8%. But they also then revised that in this report. It moved lower to 4.6%. Why is this important? Because this is what the Fed is focusing on. If you just listen to the Fed and their Fed minutes, their last Fed meeting, they are focused on not only inflation, but core inflation services ex shelter. What that really means is they are looking at things that are linked to wage growth, because wage growth is the stickiest of inflation. Once you give somebody a raise, it's hard to take it back. And seeing the growth in wages decelerate from what was originally thought to be 5.1% in the November jobs report to now 4.6% in the December jobs report, that's a big move lower, and that is a big move in the right direction for what the Fed is focused on regarding inflation. Lower wage pressures higher means lower wage pressured inflation. This is why you are seeing the markets have a party. You're seeing the stock market up 2%. You're seeing mortgage-backed securities much higher, up 80 basis points at the time of recording this. You're seeing the 10-year down 16 basis points, now to 356. Has more room to go, in my opinion, as well. So markets loving this data, and adding to this, you saw average hours worked decrease from 34.4 to 34.3. That's the lowest amount of hours worked since 2020. And it really makes this jobs report look weaker than it does on the surface, because instead of firing people, they're holding on to them, but they're allowing them to work less hours. If you were to equate what that drop of 1/10 in hours is on average, it's actually hundreds of thousands of jobs that you could assimilate that to being lost. So here's the bottom line. The Fed's going to like this jobs report. The markets are liking it because they believe that the Fed now is not going to be pressured to be higher for as long as previously thought, because not only are we seeing a decrease in the inflation numbers, which I think will continue to happen, you're also seeing some weakness in these jobs reports where wage-pressured inflation is now decelerating. Guys, I hope you enjoyed the content today. Please like and subscribe. It supports me and the channel. And until next time, I hope you guys have a great one. Take care.